we're going to dive into discussing the current market of housing as well as delinquency. Before I get there, I'm your host, Dave Putz from JKP Holdings. Alongside me, as always, Mr. Nathan Turner.
Hello, hello.
Hey, sorry about that for a few minutes, guys. What's up new, man? The summertime's coming to an end, which is kind of sad. School's starting back up. And tell us about what you're seeing in the market currently and what's going on with the note space right now.
Really interesting. I'm seeing more and more seller finance notes coming up.
Mm-hmm.
It's been kind of surprising, honestly. I know it's been around forever. I mean, I did it back in the early 2010s, and it's been around so much longer than that. If you talk to some people that have been around for a little bit longer, it's been around forever. But it's just more and more lately, I feel like we're seeing a lot more seller finance, specifically people that are doing it as a business, where they're acquiring property, selling it on terms, and looking to sell the note. Seeing quite a bit of that lately.
Yeah, absolutely. I think this space is changing quite a bit, right?
Mhm.
Um, I think it, a few months ago, a few years ago, we dove into seller financing, and we've now
Mhm.
living and breathing it on a regular basis in the note space, something we didn't have 5, 6, 7 years ago,
Right.
right? It's amazing how we adjusted as times changed. For those who don't know us and are new to us, we've been in the note space for over a decade. And for the first 10 years of our business, we bought from banks, hedge funds, and we bought
Mhm.
non-performing notes
There
for
were
years.
thousands of them,
Yes.
thousands. And
Yes.
so we bought a pretty good share. I mean, not thousands, but we bought a pretty good share of those notes over the
Yeah.
time. And it's great. But that's one of the things I love about the note business. There are so many different ways to approach it. And so as times change, as the market changes, it's easy to sidestep and move into another version of notes that
Yeah.
it's always been there.
Yeah. Absolutely. Um, I think though, for our understanding, what do you think the major reason why it's changed?
That's a
What has
really good
changed?
question. I think a big part of that is rising interest rates. With interest rates being higher, it's tougher for people to qualify to bank. Um, I think
Right.
that's a big reason. I'm also hearing, and I'm curious what you've heard as well. I'm hearing from a lot of, especially in Texas, um, immigrants who are coming in who don't trust banks, and they're happy to pay a higher interest rate simply because they don't trust banks, and they would rather do a seller finance deal at a higher interest rate.
Yeah. It's it, it it's amazing because just a few years ago, reason we weren't buying seller finance, we didn't have to,
Hmm.
right? We were able to get a lot of that stuff done because of what was available to us,
Right.
right? And now we're in a spot where we're chasing 8, 10% returns just a few years ago. Now that's gone up because of our cost of capital has gone up.
Right.
Where we've done the last couple of years on the show is really connecting the owner finance, seller finance world, wrap world to the note world, because we can buy a lot more seller finance, owner finance notes than we can bank Virginia notes. And the major reason is interest rates changing, right?
Yeah.
Most people say, well, interest rates at banks are 7.5%, 8%. We're telling you, we're not buying the paper they originated 6 months ago.
Right.
We're not buying paper that originated a year ago. Most of the notes when we buy from those funds are coming from a couple years ago delinquency when
Yeah.
it trickles down to our level.
Yeah.
So
And,
when
and
we,
we're certainly
yeah,
not buying stuff from 4 years ago when interest rates were at 3%.
yeah,
It doesn't make sense for us or for them.
yes. And I think it's not available to us to buy the 7.5% loans, and we can't buy the 3.5% loans. And for
Mhm.
those who are creating notes, listen carefully. The reason is for me to get a 12% return, I need to discount your 4% loan dramatically down to get my 12. I have a yield
Right.
chart if you'd like to reach out. So that's the problem, right? And the fact that, listen, you can make a 30-year note, but a note value is in the property, the collateral, and the numbers behind it. So
Mhm.
when notes are sitting at 5%, to get a 12 is a lot of money change, right? So for me, it's really difficult to say. But seller finance notes, our 9.9, 10, 11, 12 always been there.
Yeah.
And now since I can't buy those bank originated notes, you guys in seller finance world are awesomely attractive.
Yeah.
However, we're talking off air. What are some of the issues you're seeing with the seller finance paper?
Uh, the seller finance, as much as I love it and I highly encourage it, I think that it's doing a great service to the world and the communities in general. It
Yes.
has to be done correctly. There is a right way and there is a wrong way to originate paper. So follow the rules, do it correctly, do it right. Not only then are you protected as the originator, as the lender, but then it's much more attractive to a note buyer like Dave or I, and then
Yeah.
we can pay you more. So it's for everybody's best interest, the borrower, yourself, and for us to do that correctly. Go through a mortgage loan originator, just do it right, and we can do so much more
Yeah.
business.
Absolutely. Um, so I know we have a bunch of stuff going on in the feed from LinkedIn and Facebook. We're streaming live on both services. This will be recorded. We'll be putting it onto our podcast as well as our the YouTube channel we have. But what we wanted to get into today is when COVID first hit, we are curious when the bubble was going to hit.
Mhm.
We're seeing a lot of seller finance people say, well, my value, my property is this dollar amount. And why are you guys not buying it? It's a 13 interest loan. Because the fact that we understand how the market goes and that can adjust in a blink of an eye. And that's scary for us, right? Because if it defaults, and we're a little bit hesitant because we live in a world where everything defaulted for 10 years, right? That we're expecting it to default. And if that happens, the only thing we have available to us is the house. And if that drops by 20, 25% because the bubble hit, we need to be able to sell it at auction. And that's
Mhm.
where we could become scary, right?
Yeah.
So
Ideally, we don't actually want to own the property. We really
never.
don't. And so it's if that becomes a situation where all of a sudden we become homeowners, that's our worst case scenario. That's not what we
Absolutely.
want. So
Absolutely.
we're looking to make this done correctly. We are going to buy at a discount because
Yep.
of that risk factor. And again, where we're coming from, everybody's going to default.
Yeah.
Everybody. So
Yeah.
that's kind of in the back of our minds.
Yeah. I'm waiting for myself to fall, put it that way,
Yeah,
right? That's our
exactly.
mindset. And I think for us, the only two things we really are very hesitant, and we've had shows about this. So if you're new, please feel free. Land and mobile homes just don't fit for us.
Hmm.
Um, I'm sure you get a lot of information from people. And if you are looking for land or mobile homes, we're getting those call outs from people who watch our show and saying, hey, just reach out and say, hey, listen, I do buy land, right? We just don't buy it. It just
Yeah.
doesn't work for us, doesn't work for our portfolios and
Right.
whatnot. Um, we are, for those who don't know, we are two different companies. We just work together on this show and collaborate on a lot of stuff. So there's things that Nathan will buy that I won't, and vice versa. But it's interesting.
Yeah.
So let's real quick before we bring our guest on. DME is
Yeah.
coming up in May of 2025.
Yeah. New date set May 2nd and 3rd, 2025, back
For
in
those who don't
Nashville.
know anything about
Can't
it,
wait.
what is it?
It is the place to get together with other note investors. So whether you're brand new or you're managing multi-million dollar fund, it's the place to come together, network, talk to other people, and hopefully get some deals done. That's really, really what we're hoping to have happen.
Yeah. And if you're a note creator, note originator, it is the place to meet your bride,
Oh,
right?
yes.
In the idea that, hey, listen,
Hmm.
I'm creating all these notes. I'd like to sell them, which is an awesome idea that if you've never heard of it, you can literally sell part of your note, some of your note, create a first second. We talk about this stuff on a regular basis because creating a first second allows to buy that first at a discount where I'm coming out with an infinity return calculator that you guys can calculate and create a first and sell it Nathan or myself in a blink of an eye, get your debt completely paid off and have a second for the next 30 years paying you $125, $200 a month forever, and we're happy, you're happy, and get out of it. So if you're interested in that, please reach out and get back to me, and I'll be sharing that link. A shout out to a couple of our listeners for encouraging me to do that. So
Yeah,
with
that's
that
exciting.
said, we've been waiting for a housing market change for a long time.
We thought it was going to be COVID, and it wasn't.
Yes.
Not in the
Yes,
direction we thought it would be.
correct. And interest rates went up. We thought it happened then. We thought everything was going on, right? And Melody, who was going to be bringing on a second, she showed up at DME. We didn't know who she was, what she's doing, and she impressed us the first second talking to her. So I think for me, bringing Melody on here is awesome. If you don't know who Melody is, please look her up. She's a huge YouTube following. It's just amazing to hear from Melody. So, Melody, welcome to the show and thank you for joining us.
Oh, thank you so much for inviting me. And you guys have been amazing in what you've taught me about this space. So happy to be here.
Awesome. Awesome.
And that's the first thing. First of all, you're impressed with our space. We're incredibly impressed with what you've done. So we'd love to hear about kind of your background. Where have you come from? What have you done?
Yeah. So, and sorry, I'm getting over a little cold. It looks like you are too, Nathan.
A little bit.
So I might have to cough a little, but, I fell into mortgage as most people do. So my background that started in this space was really in the mortgage space. And so I was in grad school looking at my student loans and wondering how the heck I was ever going to pay those. Being, 10 is not really something that people get anymore typically. And so I needed a job, and I had a lot of skills. I'd worked while I was in grad school at the Wall Street Journal. I'd worked for some private investment banking firms. And so I thought, okay, I'll be a project analyst. And so I saw a job for project analyst. I went, the guy said, "So what made you want to work at a mortgage company?" And I said, "This is a mortgage company?" I mean, I had no idea. Until this day, I've never had a mortgage, guys. Mortgage means death pledge. I have that same kind of, but we understand in this country, that's how we afford homes. And so I don't have anything against mortgages. I have, I encourage people to be prudent. But I ended up at that mortgage company in September of 2006, just in time to go to a party where they dropped balloons down from the sky and they had a life-size Lego house and this huge event. And I turned to my friend and I said, "Is this Enron?" Because I'd only ever seen people dancing on stage and this excited, from scenes from Enron. Sure enough, Cerberus, which was private equity, had just purchased us at the top. We were operating under GM at the time, General Motors, and we were hugely successful for them when they weren't doing so well. So we were the darling. And so private equity came in to purchase us. And then quickly, very quickly, I mean, in Q3 of 2006, we were at a 1.71 delinquency rate, but things just started snowballing from there. And because Cerberus wanted to adjust the purchase price, we were very early in taking our write downs, and because they had a gun to our head. So meanwhile, Chase, Citi, B of A, they were late to the party. And I would encourage everyone to understand they're always going to be late to the party. And I can I can give a quick example. JP Morgan just came out with its earnings release. When they were talking on the street, they didn't mention anything about their home equity portfolio being over 6% delinquent. Not a word. But if you go into their 10Q, it is. And so they're going to put off those write downs as long as possible. And so I would just say to everybody, if you're getting your news from mainstream media, you're going to be behind the curve. That's just the way it is. Unfortunately, it's just full of narrative. So anyway, so we led the charge in total chaos. We were number one on the list for most likely to go bankrupt from mortgage. What was that thing called? I can't remember, but it tracked that every day because mortgage companies were just imploding.
Yeah.
We did not for a very long time. We got saved by TARP. And so part of what I did for Cerberus was teach them the business, because we were this massive company. I had to go out all around the company getting management reports and tell them, okay, this is how this works. This is how that works. And so I got a crazy education in a very short amount of time that it's a once in a lifetime opportunity to really get that kind of education that quickly. And plus, we were laying everybody off. So you're there, you're the only one left, right? You're keeping the lights on. And so from there, I kind of went and I helped manage our consent orders and AG settlement when we got into trouble in 2011. For basically what happened is we had too many defaults and the organization was kind of being starved. So we got TARP money, we got SAVE, we became a miraculous bank holding company overnight, even though we only had this tiny little regional bank in Utah, but it was, it was a
Mm.
lot of engineering to save us and GM. And then from there, we got into a little bit of trouble with the consent orders on robo signing affidavits for default. And all the big five did. And so we had to pay our regulatory dues. And from there, really, we knew that the operation would not make it. And so ultimately, we filed bankruptcy, and I helped to manage that. It was one of the largest, most complicated
Wow.
bankruptcies at the time, and it's still going on anyway.
Mm.
So from there, they said, okay, well, thank you for what you did with the consent orders, AG settlement. Thank you for helping us with the bankruptcy. Could you please go fix default? Because, all that trouble we got into, and now Fannie and Freddie are saying, hey guys, we understand we're not going to let you modify these loans. So you need to
Yeah.
push these seriously delinquent loans, or we're pulling all your servicing, which would have tanked the auction and meant tens of thousands of people would have lost their jobs. And so I went out on the road all across the country with my document execution teams into attorney firms, because that's what you use local counsel to work with foreclosures. And I got a real education in default, and not one state, just all across the country. And there's not a lot of people that get that opportunity
Yeah.
either. And so basically, with a lot of elbow grease, because we were in bankruptcy, Bank of America was paying these firms like, thousands of dollars to move theirs faster so they
Sure.
wouldn't get in trouble with the agencies.
Yeah.
We just had elbow grease. And so I lost a lot of my life on the road those couple years. And then from there, after that was over, my Fannie Mae rep won an award because we did increase our pull-through rate. So she won the award. That's how that works. Yep. I went off to a whole bunch of non-bank originators and servicers, I thought what I was doing was actually helping them to kind of get up to speed with the new regulations. But what I ultimately have realized is that what all that was, all those regulations, Dodd-Frank, I mean, it was just lipstick on a pig. It was to make everybody think that everything had changed. Meanwhile, in the back end of the automated underwriting systems, they quietly removed in 2021 the DTI threshold, or debt to income threshold. And so
Wow.
I think a lot of that was what I call it credit quality gospel singing. There was a lot of singing about how strict everything was. And I think if you talk to anybody at the end of the crisis, 2012 to maybe 2016, 17, things were very like lockdown, strict, crazy. But then, like loosely, as always, no one went to jail, or very few did. Things just started, opening back up again. And I was experiencing this and just thought it was my personal problem. I thought something was wrong with me, or it's the company I'm at. They don't want to comply. But no, it was industry wide. And in 2019, I went on a project. I was building technology. The last several years, what I was doing was building technology for the industry. And I went into an originator, and the front row of the car, the front of the building was just all Lamborghinis, Porsche. And I walk in, and I'm like, you have to be kidding me. This is happening again. Like, so anyway, all that we get to, the COVID boom, which was just pure insanity. I was working on an imaging project for PNC overnight after, COVID lockdowns are announced. We just get this flood of refinance applications. So we're processing images. We're processing over 1 million of them a day in 2020. I mean, it was absolutely insane. And it was, none of us slept, none of us ate. Like, from 2020 to, I would say, middle to end of 21, I don't think anybody in mortgage slept. And guys, that's a problem, right? That's when so many mistakes and things like that happen. And I really got out of there. I had this crazy little team that was doing loan processing, even though I was building technology. We were like this small fintech business process outsourcing company. And so you wore a lot of hats. But I could see some of the financials that were coming in. And if I got called in to look at an issue, I mean, you had crazy stuff like people all in Tesla. I mean, there's so much risk out there right now. I can't even explain. But then my president said, "Can you please just tell me when are rates going to rise? Because when is this party going to be over?" And that's all I could think about. When is this
Yep.
craziness?
Mhm.
And anytime I would talk to anybody about what was going on with home price appreciation, they would just dance. And I'm like, you do realize what happens with home price appreciation or HPA? Property taxes go up, home insurance goes up,
Yep.
costs of repairs go up. All of a sudden, you have a consumer that is getting stretched and stretched and stretched.
Yep.
But nobody wanted to hear it. They wanted the balloons to come down from the ceiling again. They wanted to create another Lego house. And so I started diving into macro. That's, David, when I got onto Twitter, even though I had no desire. I don't even go on Facebook. I'm like anti-social media. But that's when I really started connecting with other kind of financial media commentators, macro people, economy. And I really just did a deep dive into really a lot of things I studied back when I was in grad school. But I kind of picked it back up and studied it. And then I got on the road because people were saying housing's just fine. They were talking about no inventory. I was like, are you insane? Have you seen the permits? Like, have you heard them talking about all this multifamily? But nope, everybody said we're short inventory. So I got on the road. My first trip, I hit Nashville, Austin, Charlotte, several cities in Florida. And I said, guys, we don't have inventory issues. And believe me, at that time, everybody thought I was crazy. But
And
from
what
there,
time, when was this? What year?
that was in February of 23 that I
Okay.
did that first trip. I wrote an article for Housing Wire in January of 2023. It was called Debunking the Inventory Myth. And then because I got so much crap because people were like, data, data, data. And I'm a data geek. I love data. But they wanted, it's just so hard when the entire narrative is out there around shortage. And so I went on the road because I was like, I'm going to bring back footage. And I do that now with pictures or drones or things like that.
Mhm.
People still didn't believe me. But I think I got us all the way to here now. So I'll stop.
Yeah.
I know that was a lot.
That's okay.
Oh,